Spot price, $64. Your local coin dealer, sold out. Online retailers, 4 to 6 week delays. Premiums, $12 to $18 over spot. You're not buying silver at $64. You're buying it at $76 to $82, if you can find it at all. December 2025. For the first time since 1980, physical silver and paper silver have completely decoupled. The ComEx says $64, but try walking into a shop with $6,400 and walking out with 100 ounces. It's not happening. The supply chain didn't slow down. It snapped. And what's happening right now, this exact moment, this is stage 4. The stage where price becomes irrelevant because supply has vanished. By the end of this video, you'll understand exactly why the silver you see quoted on CNBC doesn't exist in the real world, and what happens next when the paper market realizes physical delivery is impossible. Let me show you how supply chains break. Because this isn't random chaos. This is a 4-stage collapse that's played out across every commodity shortage in history. Stage 1, normal flow. Miners produce, refiners process, dealers stock inventory, customers buy, the system works, supply meets demand, premiums stay at 2% to 3% over spot. Stage 2, stress signals. Demand increases, inventories start shrinking, refiners report delays, premiums tick up to 5% to 7%, but product is still available. Most people don't notice yet. Stage 3, fractures appear. Key suppliers go offline, shipping delays extend, premiums spike to 10% to 15%, dealers limit purchases per customer. Wait times measured in weeks, not days. Stage 4, complete breakdown. Physical decouples from paper. Spot price becomes meaningless. Premiums explode to 20%, 30%, sometimes 50% or more. Supply disappears entirely. And at any premium, you cannot buy. We just entered stage 4. And I'm going to prove it using real data from dealers, mints, and refiners operating right now. Let me show you what's happening at ground level. Because the CNBC ticker says $64, but the real world tells a different story. 8MEX, one of America's largest online precious metals dealers, December 2025. American Silver Eagles, the most popular silver coin in the world, spot price $64. 8MEX selling price, $81.50. That's a $17.50 premium, that's 27% over spot, not 2%, not 5%, 27%. SD Bullion. Canadian Maple Leafs, spot $64, selling at $78. Premium, $14 or 22% over spot. And here's the key detail. Delivery time, 4 to 6 weeks. They're taking your money now for silver they don't have yet. JM Bullion. Silver bars from major refiners. Premiums at 15% to 20%. But check the inventory status. Low stock on nearly everything. Pre-order on most popular sizes. Out of stock on key products. Local coin shops? Even worse. Owners report waiting 3 to 4 weeks for restocks from wholesalers. Some products simply unavailable. Customers calling daily asking when inventory arrives. This isn't a temporary blip. This is systematic breakdown. Now let me show you why. Because the problem isn't at the retail level. It's at every level simultaneously. Section 3. The Mint Shutdown. 5/38. December 2025. The U.S. Mint, the government entity responsible for producing American Silver Eagles, announced production constraints. Why? Because they can't source enough silver blanks, the raw material, the actual silver planchets that get stamped into coins. The mint buys blanks from Sunshine Minting and other suppliers. And those suppliers? They're running at maximum capacity. 24/7 operations, 3 shifts, and they still cannot keep up with demand. Perth Mint in Australia. Reports indicate rationing programs for dealers, limits on how much product any single buyer can order. They're allocating supply because demand exceeds production capacity by multiples. Royal Canadian Mint, similar story. Production delays, longer lead times, dealers reporting stock shortages on Maple Leafs, the second most popular silver coin globally. These aren't small operations. These are government-backed mints with unlimited capital and decades of experience. And they cannot produce enough silver coins to meet demand. But here's where it gets interesting. Because the problem isn't just minting capacity, it's refining capacity. Let me explain the silver supply chain so you understand where the real break is happening. Step 1. Silver gets mined, usually as a byproduct of copper, zinc, or lead mining. Step 2. Raw ore goes to refiners. They extract pure silver, process it into 999 bars, standard investment grade. Step 3. Those bars go to fabricators. They melt and reform silver into coins, small bars, industrial products. Step 4. Products reach dealers, then customers. The breakdown is happening at step 2. The refiners, there are only a handful of major silver refiners globally capable of producing London good delivery bars. Asahi, Heraeus, Pamp Suisse, Valcambi, maybe 10 to 12 total refiners that matter. And every single one is operating at maximum capacity. According to industry sources, refining backlogs are stretching to 8 to 12 weeks. That means silver mined today doesn't become available product until March or April 2026. Why the bottleneck? Because refining requires specialized equipment, skilled labor, and stringent quality control. You cannot just build more refineries overnight. It takes years and hundreds of millions in capital investment. Meanwhile, demand surged 40% in 2025. Solar manufacturers need refined silver now. Mints need blanks now. Industrial users need feedstock now. But the refiners can only process what their capacity allows, and capacity hasn't expanded. Now, add the industrial side of this equation, because it's not just investors buying silver, it's industries that literally cannot operate without it. Solar panel manufacturers. Every gigawatt of solar requires approximately 1 million ounces of silver. China installed 250 gigawatts in 2024. That's 250 million ounces of annual demand just from Chinese solar. And solar manufacturers don't care about premiums. They care about keeping production lines running. If silver costs $70, $80, $90, they pay it, because shutting down a factory costs millions per day. Electric vehicle manufacturers, Tesla, BYD, Ford, every EV maker needs silver for electronics, motors, charging systems. Production targets for 2026 and 2027 require approximately 60 to 80 million ounces of additional silver annually. Defense contractors, the Pentagon's missiles, guidance systems, radar, communications, all require silver, and defense demand is non-negotiable. National security doesn't accept out of stock. These industrial users are now competing directly with retail investors for the same limited refined silver supply. And industrial users have deeper pockets, longer relationships with suppliers, and the ability to lock in forward contracts. Retail investors, they're at the back of the line. So let's talk about the elephant in the room. ComEx says silver is $64, but you cannot buy it at $64. So what is ComEx actually pricing? Paper promises, futures contracts, derivatives, financial instruments representing silver, not actual metal. According to ComEx data, open interest sits at approximately 244% of registered silver. That means there are 2.44 paper claims for every ounce of physical metal available for delivery. In a normal market, this works. Most traders close positions for cash. They don't demand physical delivery. The system stays balanced. But December 2025 is not a normal market. Industrial users are demanding physical. Investors are demanding physical. And the registered inventory at ComEx? Approximately 113 million ounces, down from 400 million ounces in 2020. That's a 72% decline in deliverable silver in 5 years. Now, watch what happens when contract holders start demanding delivery. December 2025, reports indicate delivery requests spiked 40% versus historical averages. The physical demand is overwhelming the paper system. ComEx has two options. Deliver metal they don't have, which means default, or cash settle contracts against buyer's will, which destroys trust in the paper market. Either way, the paper price becomes meaningless, because paper silver and physical silver are no longer the same thing. Now add the factor that's going to make this exponentially worse: tariffs. The US government declared silver a critical mineral in 2025. Section 232 investigations are underway. Industry analysts expect tariffs of 15% to 50% on imported silver to be implemented Q1 or Q2 2026. America imports 64% of the silver it consumes. When tariffs hit, imported silver becomes 50% more expensive overnight. What happens? Precautionary buying explodes. Industrial users rush to stockpile before tariffs take effect. Dealers try to secure inventory. Investors front-run the price spike. And the supply chain, already operating at breaking point, faces a tsunami of demand it cannot possibly satisfy. Premiums won't be 20% over spot. They'll be 40%, 50%, maybe more. Delivery times won't be 4 to 6 weeks. They'll be 3 to 6 months. And most products will simply show unavailable across every dealer website. The tariffs are the accelerant on a fire that's already burning. Section 8. What happens next? 1618. So let me paint the picture of what the next 6 to 12 months looks like. Phase 1. Premiums continue rising. What's 27% today becomes 35%, then 45%. Dealers raise prices weekly, sometimes daily. Customers who hesitate pay more every time they check back. Phase 2, selective availability. Certain products, American Eagles, Maple Leafs, standard bars, become near impossible to find. Secondary products, foreign coins, odd weight bars, still available but at massive premiums. Phase 3, allocation systems. Dealers implement purchase limits, 1 tube per customer, 5 bars maximum. Rationing becomes standard practice. Phase 4, complete decoupling. The ComEx price and the retail price diverge completely. ComEx might say $75, retail dealers charging $120, and nobody cares what ComEx says anymore because you cannot buy at that price. Phase 5, paper market stress. When enough people realize paper silver isn't real silver, when industrial users demand delivery, when the leverage breaks, ComEx either defaults or changes rules. Margin requirements spike. Position limits imposed. Trading halts become common. This is the endgame for a market with 244% leverage on a finite physical commodity. So here's what you need to understand right now. The window for buying physical silver at reasonable premiums is closing. Not in 6 months, not next year, right now. If you're thinking about silver positions, if you've been waiting for a pullback, if you've been watching from the sidelines, understand this. The price might dip. ComEx might show $60 or $58 on some correction, but retail premiums won't drop because the supply shortage is real. The refining bottleneck is real. The industrial demand is real. You might see spot at $60, but dealers will still charge $78 or $82 because they cannot source inventory below that level. So the strategy is simple. If you believe the supply crisis is real, buy physical now. Accept current premiums, secure delivery. Because 3 months from now, you might be looking at 50% premiums and no availability. If you think this is hype, if you believe the supply will normalize, then wait. But understand you're betting against math. You're betting that demand decreases, that refining capacity magically expands, that industrial users suddenly need less silver. Good luck with that bet. Spot price $64. Real price $76 to $82. Delivery times 4 to 6 weeks. Premiums at levels not seen since 2020. Mints rationing production. Refiners at maximum capacity. Industrial users panic buying. This isn't a normal bull market. This is a supply chain breakdown happening in real time. The paper market says one thing, the physical market says something completely different. And when paper and physical diverge this dramatically, the physical always wins. Always. If you found this valuable, if this explained what you're seeing in real markets, subscribe right now, because the next video breaks down exactly what happens when ComEx faces its first major delivery default. The cascade that follows, the price explosion that results. Hit subscribe. The supply chain just snapped. And what comes next will separate those who prepared from those who waited too long. Don't be late.